Hello, everyone, and welcome to today's webinar on emerging opportunities in non-QM. Now, this one, we want it to be interactive. We want to hear from you. We want to hear your questions and your comments. So please join the conversation. Use the little questions tool to submit your comments and questions, and we will answer them during the session. We're also going to have an additional space at the end in case any questions come up that didn't occur to you at the time. So with that, I would like to just please introduce today's panel. Todd, Jeremy, Loretta, and Steve. Why don't each of you guys go around and just introduce yourselves and what you do here at LendSure. Todd, let's start with you.
Thank you, Rose. I'm Todd Harris. I'm the Western Production Manager. I run the sales and operations for the Western United States.
Thanks, Jeremy.
Thanks, Rose. My name is Jeremy Drews. I'm the regional manager for the, I guess we call the Mountain States region, which is Utah, Nevada, and Idaho.
Okay, great. Loretta?
Hi, I'm Loretta Rohani, and I'm the regional sales manager for the Southeast region, which is the Georgia, Tennessee, Carolinas, the Gulf, kind of the Gulf states.
And Steve.
I'm Steve Arledge. I run operations and underwriting for portions of the country, about a third of it.
Fantastic. Thank you so much. And Todd, why don't you take this one?
Okay, well, thank you. Go ahead and advance the slide if you could, Rose.
There you go.
If it wants to advance. Now, if it doesn't want to advance.
Oh, I'm sorry. Just 1 second. There seems to be a technical issue. Let me just resolve that real quick.
Okay.
There you go. Okay. Just let's give it 1 second. You should be seeing. There you go. Sorry. There you go.
Okay. Just wasn't sure if you knew it didn't advance. So just wanted to spend a second and just tell you a little bit about us. LendSure, we were founded in 2015. We were founded here in San Diego, California. That's where we're headquartered. We've opened up offices since then in Atlanta, Georgia. That's where Loretta's out of. We've got an office in Rhode Island. And then Jeremy mentioned he's up there in Utah. We've opened up an office just recently in Salt Lake City. We've been securitizing loans each year since 2017. We have a highly experienced management team. Now, the reason that's important and the reason that bullet point's in there is because anybody can make loans when you're making loans based off of guidelines. A highly experienced management team is important when you're looking at loans that just technically don't fit those guidelines. And so we make a lot of exceptions. In fact, about 50% of the loans that we close on a monthly basis have some type of exception associated with them. And so that's important to know, especially when you're dealing with us. So currently we're in about 42 states. We might be up to 43 now. We're adding more states as we go, and we look to cover the, we cover most of the population in the United States.
Okay. Todd?
Yeah, I'd like to talk about this as well. A lot of people will ask us, what is non-QM? And so the first thing I want to say is non-QM is not subprime. A lot of people tend to think of non-QM as, oh, it's those types of loans, whether it be subprime. For those that have been in the business a long time, the SASE, Nina, SUSI, SASE, all those acronyms that we all used to joke about, that's not who we are. That's not what non-QM is. We typically are working with all the A borrowers that you guys are already working with now, and they just don't qualify Fannie or Freddie for one reason or another. In fact, I would say probably the majority of the time they don't qualify, it's because of an income issue. It's not usually a credit issue. It's not usually an assets issue or job time, any of that type of stuff. It's usually just challenged with the income, trying to document it. Not all the time, but that's the majority of the borrowers. And to that point, if you look here, I've got some notes down. It says our average FICO is a little over 700, and the average LTV is a little bit below 70%. So when you look at that and you consider that, that's a very good book of business. And so we're closing good loans to people who are going to pay. It's just for one reason or another, they're just challenged with qualifying on the edges of that Fannie and Freddie stuff. The other thing I'd like to note is we do about 65% of purchase money business. And that's where a lot of loan officers today are intrigued and interested in working with us, because as that refi market starts to dry up, it's important to align yourself with somebody who's good at purchase loans. And we are very good at that. And so we're not looking to compete with you on Fannie and Freddie loans and the HARP loans and the FHA and all that type of stuff. We don't do second mortgages. We're just strictly a non-QM lender, working in the stuff I talked about.
Awesome. Thank you, Todd. So let's talk a little bit about the latest trends in today's lending landscape. Loretta, why don't you start us off? What have you been seeing? What do you think?
I would definitely say that the majority of what we see, which is bullet pointed here, the employment, which I know that Todd hit on, probably the biggest reason that we see most of our borrowers is probably about 80% related to income in one way or another. One of the interesting things is recently, in light of COVID and some of the recent occurrences, is that a lot of borrowers are becoming like entrepreneurs and finding very creative ways to gain revenue. So I would say that's definitely been a change in how LendSure navigates through that. Definitely with the rising prices in the current space as far as purchase prices are on the rise. So we're looking at much larger loan sizes and trying to qualify those borrowers for those larger loan sizes. And then again, the non-warrantable condos and condotels, with a lot of the shift in the agency programs, a lot more of those properties, which are extremely strong borrowers, are moving into the non-QM space, specifically because of the property type.
Awesome. Thank you, Loretta. How about you, Jeremy? What have you been seeing in your areas?
A lot of the same stuff that Loretta mentions. We service a lot of resort towns and areas like Park City and, of course, Las Vegas, even areas up in Idaho, Sun Valley. You can imagine that, in those types of areas, we see a lot of the condotels, the non-warrantable condos even, certainly a lot of large loan sizes. But yeah, I would say out of all of those, the condotels has definitely been one of the hot products for us. And when we get a lot of loan officers and now even, borrowers that start to understand that there's a vehicle to finance those types of properties, they get pretty excited about it. So we've definitely seen an uptick for sure in condotels, but all of these programs that Loretta mentioned, we're seeing the same type of stuff even in our region.
Fantastic. So we've got the latest trends. So what about the loan programs that you guys have been seeing? Laura, why don't you get us started on that one? What do you think?
So just to touch on a few, I know we just, not to repeat what Jeremy and I just spoke to, but I would definitely say that the investor cash flow, we've seen a big uptick as you see the rental market and the rent prices are being driven up. The investor cash flow, the DSCR, is a really prominent product. And we've seen, believe it or not, a big increase in the multifamily, the 2 to 4 units. In that it's larger loan sizes. So we're seeing investors go after that particular property type. With rents increasing between 30 and 40% in some areas, it's much easier to qualify the DSCRs on the larger loan sizes now than maybe it was in the past. I would, again, just to harken back to the bank statements, it's probably, I would say 40 to 45% of our business comes from bank statements with very creative income and revenue streams. So I would definitely say that would be hot products as usual. And then one that I know has had a lot of traction, and I'm sure Jeremy has as well, being in resort communities, bridge loans. As you see property values go up, borrowers are becoming more and more fearful that they're going to be priced out of the market. So you're seeing them have homes that maybe were starter homes and now going ahead and making the leap and purchasing another property for fear that they're going to get priced out. And we're able to do the loan on the departing because they're going to need that cash from the departing to purchase the new. So the bridge loan is a great product. And the terms are, in this market, properties sell very quickly. So they can make offers with no contingency, do the bridge loan, and then they're oftentimes closing on those bridge loans very quickly. So the carrying cost is relatively light if they can sell quickly in this market.
Okay. Janet wants to know what is going on with the foreign national market right now, with foreign national loans.
It's booming, especially in more of your resort areas. I know Jeremy probably deals with it in the mountain states, and I deal with it in the beach states, if you will. So it's definitely, and again, the LTVs on that product is very generous at 75%, and the loan amount, the loan size is very generous as well. The best part about that product is that you can do it as a second home foreign national, and you can use a third-party verification for the income. So you can get a CPA letter with documenting the last 2 years' income. So the paper trail on that product is pretty enticing.
Okay. Which products can we do for foreign nationals?
So foreign national is a specific product, so you can do them on second homes and non-owner occupieds. And you do also have a DSCR feature on the non-owner occupied, which is another very enticing product. So it has its own specific product, but you can do both owner occupied, second home and non-owner.
Okay. And Eric is asking about, have we been affected by the Miami, Florida situation? I'm not sure, Eric, if what you mean by that, so you can go ahead and type that in again. But what are hot programs in the Florida markets? Does anybody know?
They're probably specifically referring to the recent Sunrise building collapse, and probably how that's impacting the condo market. I think that you're going to have the impact if for anybody that may have considered a condo. I do not think it'll be a deterrent. It's not the first building that has collapsed. I understand that it's getting a lot of world recognition, but it is not the first time that it's happened. It's obviously awful and very sad, but I don't think that it'll have a huge impact long term. It might have a short term impact, but
okay, fantastic. Thank you, guys. And post-COVID lending issues. Steve, why don't you start us off with that one?
Yeah, I'd be happy to. Happily, we're starting to see that go by the wayside, the COVID at least, although we've seen a few bumps recently. But largely, people are back to work and the economy is picking up, and we're seeing that. And as it relates to forbearances, I think that's the big piece that people probably have an interest in. Any forbearance, we have quite a bit of flexibility, but any forbearance less than 3 months, we just disregard. 3 months or less, we disregard it, and it has no impact on our lending decision. If it's greater than that, it's a case-by-case situation. And I would say, for instance, we've done them up to where they had a 12 months worth of no payment on COVID relief. But, that's for people perhaps that have had that mortgage for a few years, and you've seen a good pattern of pay history prior to the 12 months missing. And if somebody only had a mortgage for 14 months and they deferred 12 of them, we might have concerns there. But we have a lot of flexibility. That's case by case, looking at the borrower, his assets, his credit, and his prior mortgage history. We do have a lot of flexibility to move on there without impacting your credit grade.
Okay. Judy wants to know what our turn times are for approvals, fundings, pre-quals.
Well, I'd like to think we have the fastest turn times in the space. And if you give us a complete file, we typically can close it in record time. So I'd say our average turn time on a complete file is about 2 weeks. Now that's pretty aggressive in today's market. And so we got to have everything that goes through smoothly. We got to have the borrower sign the consents, and everybody has to do things on time. But typically when you have a complete file, that means if it's a purchase, you've got a close of escrow date that you're really pinpointed on. And usually when you have a lender, a borrower, and a loan officer that's all focused on that close of escrow date, we can keep things moving along pretty good.
Do you accept transferred appraisals?
We do. Yeah, we do, as long as they come from an AMC. And so that's something that will make its way up to somebody like Steve Arledge. They'll take a peek at the appraisal and just make sure that there's nothing glaring on it that just stands out. And 98 times out of 100, we accept that transferred appraisal.
Okay, fantastic. Thank you. Structuring loans. Todd, why don't you start us off on this one, on this topic?
Yeah, I'd love to. I think we have a couple of great things that set us apart from the competition. One, the first bullet point there is interest only. Some of our competition does not do interest only loans. And when we talked a little bit earlier, a couple of slides ago about, some of the loan programs, I don't believe interest only was mentioned, but this is definitely a program that's interesting when you start combining it for investors who are looking for lower payments. On the DSCR program, we qualify off of the interest only payment, so that allows us to offer better pricing or a better LTV. So there's some interesting things we can do with interest only. But most importantly, this interest only that we have up here, the 10-year IO with a 40-year fixed term, that's a beautiful program because it's essentially a 40-year fixed loan. For the first 10 years, it's interest only. And after that 10-year period is up, it reamortizes to a 30-year fixed loan at that same fixed interest rate. So it really is a beautiful program. It's very popular. Investors know exactly what their payment's going to be. They can pay, they certainly during that IO period can make more larger payments and start paying down that principal if they want, but they have the option to make a smaller payment, and that frees up a lot of their cash flow. And the interest rates are very good on that program. And the interest rates are very good because of the, the following bullet points where it talks about the rate buy down and the stacking. We have a unique thing that we're able to do at LendSure, which is to take your borrower paid compensation or your lender paid compensation, the compensation to the loan officer, and we can put that compensation on top of the loan amount. We call it stacking. That's a LendSure phrase, not an industry phrase, but we call it stacking, and we increase the loan amount. And by doing that, if it's a purchase, that borrower does not have to bring those funds into the closing table. So they can come to the closing table with less closing funds. And then at the same time, we can actually buy down the interest rate and take that cost to maybe buy down the interest rate, and we can stack that amount. So when you're talking about an interest-only program, for instance, you can actually keep the interest rate low because we're not increasing the interest rate to pay for the BPC or the LPC. And then you can actually buy down the interest rate to get an even lower interest rate. So that gives you a really low start rate, really low payments. I won't get overly detailed with how it works, but if there's people that have not used LendSure before and they're interested in it, I would definitely ask them to get in touch with their account executive or their sales rep, because it's a beautiful program and it really gives the loan officer and the realtor that the loan officer is working with a big head start, a very strong competitive advantage.
Okay, great. Jeremy, are you seeing a lot of these programs used in your region?
Yeah, so going back to a lot of the investment property purchases, whether it be condotels or just regular investment properties, SFRs, non-mortgable condos, as Todd mentioned, we're not as tied to TRIB like we are on owner-occupied properties. So, again, to be able to use a starting payment and take an IO payment to qualify them, especially on our investor cash flow program, that's huge, right? And so when you start getting investors that are really looking at cash flow in the property, and the payment is obviously very important to them, the combination of the buy down and interest only, and then on top of that, be able to finance that buy down into the loan, that's a home run for these investors. So considering how many investment properties, again, we're doing in the Park City or the Las Vegas areas, those types of areas, this type of structure that Todd alluded to is big for these guys. So we're seeing all the same types of trends with these investors.
Awesome. How about you, Loretta? In your region, are you seeing which of these features are you seeing a lot of?
It's really a combination of all of them, right? And that's the other thing too, is that you can use a combination of all of these on the same transaction. One of the things I would also say too is just, hearkening back to the jumbo and how extremely competitive we are on the jumbo program. You can get rates down into the very low threes using a combination of the program itself and then using the buy down options. If you're at low LTV, so like Todd referenced that you can stack two, and again, not to get too far down a rabbit hole on it because it can be a little complex for understanding, but if you're at a lower LTV, you can essentially, we stack 2% LTV. So it's not just 2 points. It could be, depending on the LTV, it could be much more than that, to allow you to do a combination of financing in the LO compensation, as well as contributing to a buy down. One of the other things that I would just like to mention is that when you're dealing with borrowers in this housing market at this time where the prices are really they're rising very quickly, we offer the stacking option up to 87% LTV. So if you've got first-time home buyers or people stepping into the market that maybe don't have a lot of reserves, you're already helping them, because before they were going to have to come up with the down payment, the reserves, and the closing cost. Well, you're already giving them a 2% leg up on the closing cost that they would have to then document those funds elsewhere. You're going to already have it built into the loan. So I think we use them all quite generously on all of our products.
Okay. Jay wants to know what the LTV is on a 10-year interest-only 40. Steve, do you want to take that one?
That's tied to the product. The product drives the LTV, not the IO piece. So if you're talking about a DSCR on a purchase, it'd be 80%, right? 80%, and you could do a 10-year IO 1040. So, but that's tied to the, to the product that you're looking at more than it is the IO piece.
Okay.
Yeah, to clarify that, Rose, it's not a standalone product. So whereas Foreign National has its own rate sheet and DSCR has its own rate sheet, interest only is just an add-on, which you'll see on the rate sheets. And so you can add it to the loan and there's a quarter cost to it. But again, that's a cost that we can stack and you don't have to pay for up front, or you don't have to increase the interest rate if you don't want to. There's other ways to deal with it.
Okay, fantastic. Jumbo Prime, there's a lot on here, but Jeremy, why don't you give us an overview of what we're talking about when we talk about Jumbo Prime?
Yeah, no, this is definitely one of my favorite programs. I would argue it possibly is our flagship program. To start out with, we'll finance loans up to $3 million. We don't look at jumbos or even call loans jumbo the same way as the conforming world does, right? We're not held to those same standards. So, we really don't even think about what is a, jumbo loan. We kind of just use that term because obviously anything over conforming loan limits, in the conforming world is called jumbo, but we'll go up to $3 million. And, as you can see here, and as Loretta, talked to just a few minutes ago, we're down in some pretty aggressive rates, our lowest being the 3.125%. It's not uncommon for us to see rates, for all different types of LTV ranges and FICO tiers, typically, 700 FICOs and above in the, mid to high threes as well. And, again, just to add on to Loretta's comments, even if we start seeing rates, pre-buy down in the fours, we're buying that down into the threes, again, financing that buy down. And so this is just a very, very, fast growing, popular product with a lot of our loan officers and brokers that we're dealing with. It used to be that we were, typically seeing our jumbo loans come to us because of our bank statement program or our asset depletion program. That's changed even quite a bit in the last few months with the tightening of guidelines with A paper jumbo lenders, and seeing a lot of those closing times extend to 45 to 60 days plus. When we've got brokers and loan officers that understand the type of pricing and product that we can offer in these jumbo loans, and we're still closing those loans in under 30 days in most cases, we're now seeing typical A paper full doc borrowers come our way just because of those turn times and the competitiveness on pricing. So again, we're just seeing continued volume increase in this category. And then when you not only just look at the pricing or you look at the loan amounts that we can provide, but you'll also look at some of the flexibility that we have. One of these being cash out. We're not getting too shy on some large sums of cash in hand if the scenario makes sense. So when we start getting well under 70 LTVs, in a lot of cases we're seeing big jumbo $2 to $3 million loans in the 50 to 60 LTV range. That's where we start getting a lot more aggressive on cash in hand to those kinds of limits. And it doesn't really, it's not being, capped out either based on the type of property. So, again, when you take a look at, some of these other non-traditional properties, condotels again being listed here, we're not, again, turning away from different types of property types just because of the loan size. Again, when we look at, places like Park City, Utah, or Deer Valley, Utah, places like that, it's not uncommon for us to see a condotel well above $1 to $2 million. So, we'll consider all those as well. The interest only, again, depending on some of these areas, on investment properties in this level of loan size, that's something, again, that's very attractive to investors. We're using different types of income, including, restricted stock units. We're looking at, cryptocurrency on a case-by-case basis. We've got DTIs that will obviously, we would like to be under 45, but we'll consider DTIs that go over 45 and up to 50. Again, there's just so much flexibility that we provide with these programs that it's just becoming a big motivator for, more and more brokers and loan officers to turn to us for these types of products and programs.
Awesome. Jared wants to know, can I find these jumbo prime rates on your rate sheets?
You can, yeah. And so, you'll work with, again, our account executives. They'll be able to kind of help structure that pricing with you. Typically when we start to get the loan sizes above 1.5 million, there's some additional adders. We do reduce our LTVs a little bit to hedge our risk. Again, starting at about 1.5 million on up. But the sweet spot, again, for most of these big jumbo programs is, call it, 70 to 75 LTVs and under. Again, we're typically seeing a very strong credit profile with those types of borrowers, well above 700 FICOs. So when you start adding a combination of, very high FICO tiers, very low LTV tiers, you're, again, seeing some very aggressive rates in those 3 to 4% ranges. But the account executive that services each broker's local area can definitely help you structure those, and those are listed on the rate sheet.
Okay, fantastic.
Yeah, Rose, I just jump in and add one more thing to that. We typically don't distribute rate sheets in large quantities because of the stacking that we're able to do. The rates that show on the rate sheet can vary drastically depending on how we structure that loan. Some people are buying down interest rates and we're stacking it. And again, that's no money out of the pocket of the guy making the purchase. So it can be a little confusing for people who have not used LendSure before. So I always direct loan officers to their account executive or region manager to make sure that we get the best pricing out there and the proper pricing out there.
Awesome. Cool. Thank you so much. All right. Do you do a monthly rate sheet or daily?
It's a monthly rate sheet.
Yes, monthly.
Okay. Today's opportunities. So summing it all up, Loretta, do you want to walk us through some of the opportunities for brokers out there?
Yeah, I think we've touched on them during the whole course of this presentation, and so it'll probably sound a little redundant, but I think all of those, especially for loan officers, as the refi market kind of gets a little bit staler and some of the changes to the GSEs, they're going to be looking for other products and realtors looking for more purchase money. I think the bridge, the foreign national, it's kind of all listed here for you, so I won't go down it, kind of just reading it off, but I would say some of the best opportunities that we have right now in the purchase money markets, especially as the prices keep climbing, is the flexibility, the interest only options, doing the investor cash flows, bridge financing for homeowners that want to get into the dream home, that we're able to do the new loan as well as give them the temporary loan on the bridge. The blended income, you'll see it here, whether it's spelled out as bank statement loans or asset depletion, asset qualifier. The asset qualifier is just a fantastic product and program. And you want to talk about easy, fast closings. That product is just superb, especially for higher end borrowers that they don't want the hassle of loan closing. The interest only feature we touched on, construction loans and the takeout loans. I think one of the preempt questions was about construction loans, and we'll do the pre-qual for you. And then as you get closer to it, get that loan in, and we do very well with the construction takeout loans. That's one thing I will mention too, is there is we talk about bank statements a lot, but there's a newer product that I feel like our broker community doesn't capitalize on as much as they could is the 12-month third-party P&L with 2 months business bank statements. I mean, I think it's a great product, especially for higher-end borrowers that have large business cash flow. They can use a P&L. Sometimes doing the whole 24 months bank statements can be pretty arduous. They oftentimes have an operating account, so you're looking at 2 and 3 sets of business bank statements, where this product is a great program. You can do it on large loan sizes. Again, we can blend all these different features together. So I think it's an underutilized product. I wish it got a little bit more play than it does. And again, the 2 to 4 units, the DSCR, you're seeing the property values on those go up. The income opportunity for investors is great. We do 75% on those programs on the multifamily. I think that's just a few of them that I would say are great opportunities if you wanted to like advance your portfolio.
For the bridge financing, can they do just the bridge part and not the permanent?
No, unfortunately, no. That's the bridge is a very, very short-term loan. So it's really, we're really looking for the new purchase, and we're doing the bridge to be able to offer that product to them so that they can buy the new home.
Tyler wants to know, do you have cross collateral loans? Not sure what that means. Okay.
No.
Okay, fantastic. And why partner with LendSure? Steve, why don't you take this one?
Okay, there are a lot of reasons we've already discussed, obviously, but experience, flexibility, and collaboration, that's what it comes down to. Todd spoke to our experience a little bit. Todd and I have been working together for almost 30 years, I think. We go way back, and so do many of us here. We've worked together before. We've been down this road. We know how to run these businesses. And so that experience, as Todd alluded to earlier, lends to flexibility. Because we know what loans, we have a good feel for what loans are going to perform and how they're going to pay and where we should have flexibility and where we should be rigid. So we have quite a lot of latitude, as Todd had indicated in his opening remarks. Roughly a little more than 50% of our loans have some exception to our guidelines. So we have a lot of flexibility. We work with you, try and get that loan closed, a good loan for the borrower and a good loan for LendSure. So that flexibility really helps. The collaboration piece, what I'm talking about is the loan officer, the whole team. We have a team set up for each region. So they have an ops manager. He has lending authority. They have a credit analyst. That's the front end underwriter. Those are the people that collaborate with you when the loan comes in our door. So we're looking at structuring the loan with you. We're heavily involved in talking to the loan officer, working through the details of the transaction, putting it in its best light, and coming up with the best pricing, the best LTV to try to meet that customer's needs. That's where our strengths are, and we're committed to working with you to get these loans closed.
Okay, fantastic. Private label resources. So I'll speak to this one. What I've done, I'm the marketing manager, by the way, Rose. What I've done is I've put together a kit for you guys that has banners that you can use online. It's got flyers that on a variety of different programs that you can just click, insert your logo, put in your contact info, and you can start marketing right away with these. One of the things that I wanted to mention, because one of the comments that I got when people were registering for is like, how do I find the audiences for these? One of the easy ways to do is if you go to Facebook, for example, and you want to find property investors, what you can do is on the search just to put in the term property investors and either your city, your state, your metropolitan area. So let's say property investors San Diego, and then on the search results you'll just filter it and just click on groups. You'll find all these property investment groups that are on there, thousands of people that are looking for solutions, that are looking for answers to their questions, and who make recommendations to other property investors. So that's a really great resource where you can kind of post things, share information, and find people for these programs. So to access this kit, you can ask your LendSure account executive, reply to the email, the thank you email that you'll be getting shortly, and this is the link to get there, bit.ly.com, LendSure resources. And yes, we will be offering, I will be sending you guys a copy of the slides so that you can have all the notes associated with this. Quick call to greater sales in 30 days. Jeremy, why don't you speak to them about what they can expect to with a conversation with the LendSure account executive?
Yeah, you bet. So obviously, there's a lot of information that was covered today. We don't expect the loan officers that attended today's webinar to retain all this information. There's obviously a lot to digest. So, we certainly expect all of our account executives to reach out to the loan officers that attended today's webinar. We'll have the registration list out to them. So I would definitely expect them to reach out, but please don't hesitate to reach out to them either if you know who that is. And if you don't, please reach out to, to our general sales number and email, and we'll get you in touch with the account executive. But the account executive's job is to, again, help our loan officers and brokers put together programs that essentially become their own. That's what we want. And it goes back to Rose's point on the co-branding and the private label marketing. We want these products and programs to look as though they're your own, and your account executive can certainly help you do that. They can certainly help not only put together some different marketing programs and strategies with you, but we certainly would ask our account executives to continue reaching out to each branch and broker and their loan officers to help bring them up to speed and educate them on each of these programs as well. Now that most states, if not all states, are open again, we're seeing a lot of our account executives schedule in-person trainings and meetings within branches. I've personally been involved with several in the last few weeks, and those are extremely effective presentations where we're getting anywhere from a handful to 30 plus loan officers in a meeting that we can go over all of these programs again, have Q&A, and make sure that every single one of them is walking out with some good information in hand to take out to their borrowers and expand their pipelines with new opportunities and certainly some even some unique things that allow them to do more business. So absolutely expect account executives to reach out, but please don't hesitate to reach out to us as well.
Yeah, if you guys are after the webinar, about an hour after, you're going to be getting an email from me, Rose Waldy. That's a thank you email. Go ahead. You can feel free to respond to that, and I will connect you with your LendSure account executive if you don't want to wait for them to give you a call. I can have them call you right away or answer your program questions right away. Or if anything occurs to you after the webinar, we'll be happy to help. Now with Q&A. Go ahead, and anything that came up during the webinar that we didn't get to talk about, or any questions that you may have now, go ahead and use the questions tool and we will answer them now. So Paula wants to know any future plans for offering correspondent avenue versus broker.
I can take that one, Rose. We've talked about that a number of times. We just are trying to make sure that we get our product out to everybody. And so that's our biggest focus. But in certain situations, we would be open to correspondent lending. So if you had something specific that you want to talk with us about, by all means, please do reach out to us, and we'd be willing to explore any and all avenues. It's just we have to make sure that we set up the correspondent relationship so that it accomplishes what you're looking to do. Sometimes it's just a matter of having the docs in your name. Sometimes it's a pricing issue. Sometimes it's control issues. So just we want to make sure we match up everything so that it works and is a smooth process for everybody.
Okay, fantastic. What's the minimum loan size on the construction takeout?
150 is our minimum loan size, just broadly. So I mean, that's what the minimum loan size is.
Okay, fantastic. And yes, I will be, this webinar is recorded, and yes, I will be sending out a link to the recording along. It's going to be embedded right in that thank you email that you'll get in about an hour in case you wanted to share the webinar with anybody in your office. What is a construction takeout? Judy wants to know. Can you go over that again, Loretta?
Sure. So there's two types of construction takeout. So there's one-time close, two-time close. So what we typically do is it's when you're doing the track house and under construction. So there's two of them. There's two different types. So if you go into contract on new construction. Sometimes that construction can take anywhere from 4 to 8 months to build. And so you get approved up front when you're doing the initial contract with the builder, and then the takeout loan is at the end when you actually do the financing to close. And then a second one would be when you are having a custom home built. Sometimes you'll already own the loan, own the land, and you will get a construction loan from a construction company that does the draws to your builder. And then the takeout loan is the financing that's done at the end.
Okay, fantastic. All right, and with that, I would like to say thank you, everybody, for joining us today. Thank you to our panelists for your time and answering everybody's questions. If any other questions come up, please feel free to reply to that email or contact your LendSure account executive. Thanks so much, everyone, for joining us today.
Thank you.
Thanks, guys.
Thank you.